The word recession is all over the place now.
We do think that recession will eventually happen. So sort of upside versus downside in stocks is not that great.
This was Marko Kolanovic, nothing less than the chief market strategist of JP Morgan, just a week ago, calling for an upcoming recession despite a job market adding a stunning 336,000 jobs only in September. And the S&P 500 notching the best daily gain last Friday since August. But among thousands of factors, the two that most of all are going to impact the probability of going through a recession or not are inflation and interest rates, which also have a direct link to the performance of the stock market. So, what's happening with interest rates? The Federal Reserve held interest rates steady in September, keeping them at a 5.5% level. The chairman Jerome Powell said in a press conference, though, that they're expecting to raise the rates up to 5.6% this year, and next year they're going to see fewer cuts than previously planned. So why is the Fed keeping interest rates so high? The great troublemaker which started all this is inflation, the increase in prices of products and services. Inflation is not something you can directly regulate like a switch, but it's still a direct consequence of a growing economy. To make an economy grow, the interest rates are kept low by the Fed to stimulate spending and productivity, so that everybody's happy and can borrow money at low cost, build new houses with money from the future, grow companies with money from the future, the economy flourish, the debt levels grow, and the cost of living does too. Only the economy does reach a point eventually where inflation, the increase in prices in goods and services, grows too fast. So this is why the Federal Reserve's constant goal is to keep inflation at 2%. This means prices should grow at 2% per year.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
So where does this 2% come from? 2% is actually the sweet spot that has been defined because a higher value would encourage people to spend too much because of fear of increasing prices. And this would drive the inflation even higher. But a lower value would encourage people to save all the money and never spending because they know they could buy something cheaper in the future. And this would stop the economy. So compared to the 2%, we still stand at around 5.5%, the highest value in the last 20 years. In the projections, they see another increase to 5.6% by the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. All in order to finally reach price stability. Because
without price stability, the economy does not work for anyone.
So inflation forced high interest rates, which slow down the economy, which in turn hit the credibility of the stock market. So now other markets are becoming more profitable and are kind of shadowing the stock market because they're even safer, like the money markets. Safe, liquid investments that are well suited to small investors and typically invest in steady funds such as treasury bills or commercial papers. So if US 10-year treasury bills are giving now almost 5% safe, which by the way is the highest value since 2007, obviously investors are asking themselves if it's worth to risk it with the stock markets. Because why? Just for the hope of getting maybe 1 or 2% more. So this is basically what the chief market strategist of JP Morgan said last week. High interest rates are creating a breaking point for stocks. And for him, choosing safe cash at a 5.5% return in money markets and short-term treasuries is going to be for most people better than investing in something risky like the stock markets just with the hope of getting 1 or 2% more.
There'll be another 5, 6, 7% upside in equities, of course, right? But if there is a downside, it could be 20% downside, right?
The interesting thing is that the stock market didn't really feel the consequences of increasing interest rates this year. In fact, year to date, the total stock market is up 11.81% and the Nasdaq even 29.31%. But if you look more in detail, what happened is that the market has basically stayed flat and only the Magnificent Seven, which are Amazon, Alphabet, Meta, Apple, Tesla, Microsoft, and Nvidia, have grown like crazy, dragging up the entire stock market performance. So let's imagine what could possibly happen if a recession comes and if it doesn't, because the truth is, nobody ever knows. If you believe there is not going to be a recession, considering the incredible growth of the Magnificent Seven, you might actually be better off by buying the stocks that are lagging right now, sectors like consumer staples or healthcare. If instead a recession happens, the Magnificent Seven will have to catch down to where the rest is. The S&P 500 shed almost 6% since the peak in July. Some calculations even suggested it might be headed below 3,000 points, which would be at least a 30% decline from its current levels. But the weird thing is that it's not what happened so far. The S&P 500 has kept growing while the job market has tendentially decreased since 2020. According to the Bank of America, in September, investors were dumping stocks at the fastest rate since the end of 2022. We don't know if a recession will happen, but we do know that there are signs that indicate it might be at our doorsteps. We are starting to see stress in consumer spending, the US Consumer Confidence Index fell again in September, inflation is still high, rates are going to be higher for longer, and yes, the economy has avoided a recession because of a strong job market. But that's often one of the last things to crack under the pressure of high rates. Now, the truth is, regardless of how likely a recession is going to happen, we can try and set up an investing strategy based on the current situation that we have and on a long-term perspective. One step that I believe is worth pursuing is reducing exposure to volatile stocks and increasing cash holdings. Cash might not be the most exciting play, I know, it's boring, but it reduces market risk. It gives you more money to invest if a recession creates buying opportunities in the future, and above all, right now you're even able to get 4-5% even from a general savings account. Nevertheless, I'm not suggesting selling all your stocks and ETFs, because even in that case, if they were to grow in the next months, you would find yourself holding a bag of cash. But given the high yield that you can be getting with cash, you might want to reduce the exposure to risky equities a little bit. Obviously, a Warren Buffett that constantly gets new billions from investors will tell you that the best thing to do is to keep investing all, because in the long term, everything recovers. And he's right. But as opposed to Buffett, we are private people who invest with their own money, and seeing your own money decrease by 10, 20, 30%, it's not an easy thing to bear. Second point, we can't be blind to the fact that this year tech stocks rallied to a point that is most likely unsustainable, while the rest of the sectors basically flatten. We've had rate hikes, slowing economy, increasing bond and cash rates, and still the Nasdaq 100 technology sector index managed to gain 41% year to date. So another suggestion would be to reconsider value and defensive sectors, which by the way have historically outperformed growth sectors during periods of elevated interest rates. Healthcare and consumer staples are two of the sectors that are considered defensive investments because their earnings tend to be insulated from economic cycles and consumer confidence. Of course, there is also one important thing to consider, which partially even justifies this growth in the tech sector. Remember that the stock market is not the economy. The stock market is a leading economical indicator. There are three kinds of indicators: leading, lagging, and coincident. A lagging indicator tells you what already happened. A coincident indicator tells you what's happening now, and a leading indicator tells you what's going to happen in the future. So the stock market, being leading, behaves first. It anticipates what's coming next in the economy, or what people expect to happen in the future. So if the stock market falls before a recession, it will also recover before the recession is over. And the sectors that usually do well early on in an economic recovery are financials, real estate, and guess what? Technology. So maybe the stock market is actually already projecting the post-recession right now. Probably the most important thing to remember is that investing can only be successful if it's done with a long-term perspective. We can all try to predict the next months and try to buy and sell stocks to try to gain that 2-3% more or lose the 2-3% less. But in most cases, we're gonna make mistake after mistake. What happens this year isn't really what matters. What matters is 10 years from now, 20 years from now, and prices will be much higher in the distant future than they are today. So let's not get too focused on today's news. That's why, to help me give you news even tomorrow, and hopefully years from now, subscribing to the channel will be the best thing you could do to signal to me that I'm doing a good job and that I should keep researching and doing videos for you. So thank you for supporting my channel this way. Of course, don't forget to drop a beautiful like to this video, and I'll see you in the next video. Ciao.